Welcome to today's HFTP webinar. We are so excited to have you all here with us today. My name is Brittany Brewster, and alongside me is Miriam Fairchild, and we are hosting the sponsored webinar by SkyStem today. And Nancy's going to take it over and kind of let y'all know the process for today and a little bit of background about herself and the company. So welcome, Nancy.
Thank you, Brittany. Hi, everyone. So welcome to today's webinar, showing some tender, loving care for our month-end close. This month's topic is going to be on our month-end close process, which is near and dear to all of our hearts, I'm sure. More specifically, we're going to touch upon some best practices that can improve your month-end close process, and also how automation can help make that journey just a little bit more elegant. So first, I want to introduce some leading practices on what successful teams do as part of closing their books. If you have not adopted these practices, please do consider introducing them to your closing team, especially if you're not 100% happy with the way you are closing the books today. And I will say that while these tips I'm going to cover they might sound really simple and straightforward, they're not necessarily really easy to implement right away. And the reason is because these things require process changes. And as we all know, process changes are going to be hard, especially if it needs to be done manually. So where it is relevant, let's also see what happens when we do infuse a certain level of automation into those leading practice guidances. And I hope this will give you some, good ideas on what you can do with your team. And all the automation functionalities I'm going to be describing today is going to be drawn from our month-end close platform. So my name is Nancy Wu, and I lead sales and customer success for SkyStem. My background includes a stint in external audit, and then a long time as an internal auditor. And then later on, I have spent a number of years as a consultant for different finance and accounting teams, primarily helping them do things like streamlining month-end close, set up AP shared services centers, outsourcing, and improve the month-end close and internal controls environment. Our company is based out of New York. It's called SkyStem, and we make a software called ART, which is a month-end close automation platform. I'm going to be sharing some screens here and there, but it is a very easy to use platform. It's very fast to implement. It's very affordable. So if you're looking and thinking like, I do want to implement some of these leading practices, or maybe just, use fewer spreadsheets during your month-end close, then I would encourage you guys to come to our website and take a look at what we do. I do have a handout for you today. If Brittany, you want to put that URL in there. It's a one-pager, and if you're just curious about, real quick, 2 seconds, what it is that we do and offer, that would be the best way to check it out. You can also visit our website at www.skystem.com, where you can do things like sign up for demos and download ebooks and that sort of thing. If you are active on LinkedIn, I would encourage you to join our free CPE network group. You go to LinkedIn, and in the search bar, just type in free CPE network, and the group's going to pop up. So that's where we post anything that we come across, whether our events or somebody else's events that are either free and offer CPE or heavily discounted and offer CPE. So that's going to be a really great group to join. If you like today's webinar, we do a lot of webinars here at SkyStem, all for CPE credit. So I'm actually coming back to talk about something called the Goldilocks dilemma. It's around selecting software and how to figure out what is the best software for you in your evaluation process. So if you're interested in that, that's going to happen next week, and you can sign up on our website. And later in March, I will be doing a topic called Back to Basics with Reconciliations. Now, because we're talking about the close process today, I will be touching upon account reconciliations. But if you feel like you want more information on that, I suggest you sign up for this webinar in March, and that's also available to sign up on our website. It's one of my most popular topics that I do several times a year. So this will be a really great refresher course on reconciliations. For those of you who are on LinkedIn, do look up our SkyStem page. Do follow us. I have a personal goal of getting 1,000 followers. this year on SkyStem, and we're very close. I think we're at like 300. So if you are active on LinkedIn, do look us up and do follow and join SkyStem. Brittany or Miriam, did you guys want to do some housekeeping before I start?
I think you're good. We just want everyone to remember they are muted. And if you guys do have questions, Nancy does not want you to hesitate. Go ahead and post them. Let her know what kind of questions you have. And then at the end, we'll kind of wrap up. So yeah, all you, Nancy.
Okay, sounds good. Let's go ahead and run our first poll. So today we'll be issuing 4 polling questions, and to qualify for CPE, you're going to have to answer 3, at least 3, but don't limit yourself. 3 of the 4 polling questions. All right, so question 1, how many people in your organization get involved in the close and reconciliation process? It's really helpful to understand from this audience what kind of teams our folks are coming from when we're talking about the close, whether it's under 5 to 15, or slightly larger teams. All right, I feel like that's enough time. What do you think? Yeah, so it looks like most of our teams are coming from 5 to 15 or under 5. So I would consider this small to medium-sized teams. Okay, we can go ahead and stop the share. So before we dive into the actual best practices when it comes to, do I need to end this poll or?
It's ended. You just need to exit on your side. Since
Right.
we're on this side, you keep it. No worries. Yeah.
Yeah, it's ended for me now. So before we dive into the actual best practices on month end close, let's first touch upon the importance of building a repeatable process when it comes to this, right? Why do we bother to follow a process of any kind, right? Well, we want to follow a process, first of all, to maximize our own efficiencies, right? Computing new information, making decisions do require a lot of mental energy. When we develop a process to follow from time to time, it allows us to internalize the work so that we no longer have to expend the initial amount of energy to think about. That's what following a process does for us. It gets a job done with less effort because the activities become routine, and it helps us perform the job over and over again, while at the same time taking less and less of our brain power to complete it. Second, having a process allows us to establish a baseline that we can build upon. For example, if we do end up thinking of a better way of doing something, an idea to get around the problem, we can build that into our existing knowledge baseline, thus continuously improve upon what we know. And lastly, we follow a process to be consistent. Once we figure out a way to produce a desired outcome, right, we want to yield that same outcome over and over again. And when you follow a process, there is no need to recreate that wheel every single time. So how do we know if our current month-end close process is good or not? Well, let's first take a look at a week process. Right? What happens when you don't have a well-rounded process around the close every month? Probably the biggest telltale sign of a weak month-end close is having unpredictability, whereas 1 month's close is different than the month before, and it's kind of hard to tell next month what the close is going to be like. And this could be in the form of fluctuations in your closing timeline. Let's say 1 month is 5 days and another month is now 10 days. This can happen when folks are just working on their own schedules and we're not really synced up, we're not coordinated, right? Maybe I'm getting ready to close AP, but we're still processing invoices in that other area, things like that. So that's what I mean by unpredictability. Lack of accountability. This is also a problem with weak processes. Who is supposed to be doing what and when, right? When your close process is not up to snuff, we can't really say for sure that the activity will be done and who's on point to do it and when it's going to get done, right? It's almost like up in the air sometimes, we're not really sure. How about this one? When we don't have a good close process, a very common symptom is that we're really not able to measure it. So we can't tell if we're doing a good job or not because there's just no data that's available to be gathered. And because there isn't enough data to know how good or not good we're doing, we also don't know if and where we should be doing things differently. So we just keep ending up hobbling along for a very long time. A troubled close process is not very auditable. So this would be not enough validation, support, audit trail that can be readily presented to your auditors. So your T's aren't crossed, your I's aren't dotted all the time. So when the audit arrives, it's kind of like a big scramble to get all of our ducks in a row. So this is not a really great position to be in. Fragility is another sign of a close process, where your activities are prone to breakage during the close, meaning that it's very reliant upon Sally, the senior accountant, because she's the only one who could do this work. So if she's out, then we're just all going to have to wait for her to come back to then do her work, right? Again, not a great place to be in. A lot of processes that are not very robust, they lack high-level reporting, where you don't really get to see what is happening during the close. You have trouble gathering data that can be produced accurately, consistently, and timely. These are all, kind of impossible asks for a close process that is not very mature. And then finally, a troubled close process is really more prone to experience adverse events, whether it's flat out fraud, whether it's a deficiency if you're publicly traded, whether it's just some material error in the financial reporting process. These are all signs of, a close that is just not doing so hot. So if some of these are hitting home for you, don't worry. We're going to cover some leading practice techniques on how to retool your close process, or at least revisit it from a different angle to avoid, or, to avoid, I guess, some of these scenarios from happening in the future. And then we're going to talk about layering on automation to strengthen your new and improved month-end close to then reduce as much as possible human intervention. And for the purposes of this discussion, I talk about the close process, quote unquote, a lot. I'm really talking about these buckets: subledger or subsystem close, calculations to come up with adjustments to the general ledger, journals, deferred costs, accruals, etc. Booking the journal entries themselves, the month-end reconciliation, doing some kind of consolidation. If you're doing flux or variance analysis, that counts, and a financial statement issuance, and either regulatory or SEC reporting, right, if you have that. So if we're not 100% happy with the way things are working today, how should we build our close process to take it to the next level, right? Where would we even start in all of these boxes? And oftentimes what we hear a lot, because I speak a lot with controllers and CFOs as part of my work. So for managers and execs who are looking to make improvements or benchmark their close process, they're oftentimes really tempted to start by looking at the number of days it takes to close, or the number of heads it takes to close, right? That sounds really sexy. And while we do want to get all that eventually, we normally recommend a different approach. We want to kind of start low, start at the ground floor. What you may be surprised to find out that one of the biggest factors that is going to impact how much work and what kind of work your team will be doing during the close is actually your chart of accounts. I don't know if you know this. For any close process improvement work that I've done in the past, the ideal starting point would be to work on a company's account structure. Why? Because typically, the more active accounts there are, the more work there is to be done. It's kind of like this upstream, downstream effect, right? More accounts mean you're probably recording journal entries to more places, right? You have the option to record to more places. And what that means is you also have a higher likelihood of making a mistake, which then require a reclass or an adjustment. If you have more active accounts, it means more reconciliations that you do or supposed to be doing. More accounts means that you're going to be doing more analysis on these accounts. Finally, if you're frequently adding accounts to your chart, it also means more management has to be applied around the opening and closing of these accounts. right? Because most of the time that kind of management is pretty manual. And it's easy to not follow the steps or miss those steps. So that's why we want to start with a chart of accounts so that we can properly manage, because that's more upstream, right? And when we start with a chart of accounts, we're going to properly manage all the work that is going to create downstream later on. And a question that we get sometimes is, well, why would my chart of accounts be out of whack, right? Because we use it all the time. There are actually several reasons why your current chart may not be best suited for your business today. Number one, it's possible your business has changed, right? This will be a situation where maybe the chart was originally designed to, maybe cover 5 properties if you're a hotel, or it's originally designed to do a resort, but the business has really changed, added, removed, changed their service offerings. Number two, you could have a merger or an acquisition or a divestiture that has occurred. That's really common, right? Where the new business is not really that similar to what it used to be. So, and a lot of times your chart of accounts and accounting is like the last thing that people think about when it comes to a merger and acquisition. So it's very possible that your chart has not been adjusted to reflect the new business, or it was just kind of very hastily expanded or fixed so that you're kind of dealing with a bit of a monster on your hands. System changes. This happens a lot. Anytime there is a system change, a switchover, upgrade, the chart may not get the attention that it deserves, and it may be negatively impacted during a conversion. So that will be another reason why your chart would be out of whack. Or sometimes nothing changed, right? It's just that we're very loose around account management. When a business doesn't control the account creation activity very tightly, you end up just getting all kinds of accounts that are opened or available to use, and lots of accounts just sit there for really no reason. They just kind of grow out of control that way. So these are all really good reasons to go back and kind of take a fresh look of maybe like a, look at it as a stranger look and say, what is really happening to our chart here? And does this really fit what it is that we're trying to do today? And in some cases, you may find that your chart of accounts can be kind of bloated. So you want to arrive at a set of accounts that really strikes that great balance between giving management adequate insight to run the business, and also making sure that your accounting workload makes sense for, if you have 3 people doing the accounting, the work has to make sense from a chart of account standpoint. So this exercise is really best done with management. So you need finance representation, operational leadership, making sure that it's not just one person sitting there and be like, all right, here we go. And this is what we're going to be changing. So once you arrive at a better set of accounts, usually that means smaller, the next step is to start locking some stuff down. Again, we're trying to limit the amount of work that we do every month. So if there is an account that we don't really use, or maybe we don't anticipate using, or maybe it's supposed to be deactivated, but for whatever reason it's still active, you probably don't want to be thinking about them every month. And the best way to not worry about them is to leverage your general ledger functionality and physically lock them down, prevent access to those accounts. If nothing can be booked to it, then you don't have to think about them anymore, right? So to the extent you can lock them down in the system, lock them. To the extent you cannot lock them down, a lot of GLs are like that, especially the smaller ones where for whatever reason, you can never inactivate them. So if that's the case, you're going to have to apply some management rigor around, okay, we're just not going to use these accounts. In our automation platform, for example, we can actually track down accounts that are, not locked, but shouldn't be used, and we can handle them in a certain way. But absence automation, you can still control it just, with brute force, making sure that certain accounts are just not used because we're not going to expose them to any risks. Once we lock down the account that are not in service, the next step is to give all of our remaining active accounts a home, meaning that every account needs to belong to somebody. Again, we're still talking about making the close process better, but we're going to start from just foundational, right? The person assigned to the account should work on this account regularly. They should have good knowledge of the account. And you might ask, what does this have to do with building a stronger and I guess more exciting close process? This is about establishing accountability. Accounts that belong to someone are more likely to be cared for. If there is a problem, an issue, a thing that is weird, because there is ownership, there will be no question as to who needs to follow up and take action to resolve the issue, right? Kind of like the buck stops here. On the other hand, you have an account that's an orphan, nobody owns it, it just kind of floats around, stuff gets booked to it, and because it belongs to nobody, it's going to be a lot harder to get people to pay attention to it. So that's why we always advocate you got to have an owner for every single account that is active on your chart. And in a traditional / manual world, and hopefully you have this, you're talking about a spreadsheet matrix, right, of sorts, where there's a list of accounts and there's names next to it. That's what we're talking about when it comes to ownership, and that person probably reconciles that account on month end. That's how you generate the reconciliation checklist. Okay. So with automation, you can actually abdicate, eliminate this task and sort of let the machine take over. So this is a screenshot from our solution. This would be a reconciliation checklist, and our system, the machine, is always actually tracking ownership and watching for what are these accounts doing, and are they supposed to be not active, but somehow things are getting booked to it. You can actually get a little bit fancier with risk mitigation when it comes to automation, because you can allocate risk frequency and reconciliation frequency, and depending on the behavior of the account, you can say, oh, well, this month, this account is like much higher risk, so I'm gonna do 2 levels of review as opposed to 1 level of review, things like that. So the amount of controls you place upon it can be automatically configured based on the increase or decrease of the risk level. Oh, it's time for our second poll. Let's go ahead and generate our second poll if you can. All right, so which of the following items belong in a closing checklist? Just take a guess, because we are going to cover this later on. Is it the close activity? Is it the due date of an activity? Is it the policies and procedures? Is it ownership, meaning who owns what? Or is it all of the above? We're going to give it about 20 seconds. All right, it looks like we're still answering polls. All right, 5 more seconds, guys. Let's get our answers in. Yeah, it looks like that's right, all of the above. Most of us got it right. All right, so now we have our accounts in place. Next, as you get into the close, almost everywhere you read, you will see that in general, following a closing checklist is highly recommended. And hopefully you have one. And if you have a calendar, if you have a closing calendar, we'll talk about that in a bit. But I'm really speaking right now specifically to the closing checklist. So what goes on our closing checklist? We need to make sure, first of all, that we have some basic information around our close. Every checklist should have, number 1, at the minimum, the thing that needs to be done. So we might talk more if we have time later around what those activities should be, but the task should be pretty granular, and it should not be written as sort of several tasks together, right? So a lot of times I see checklists and it says fixed assets. Well, that's not really that informational, right? It's actually compute the depreciation. It is do the fixed assets roll. It is to book the depreciation. It is to, do the XYZ write-off. It needs to be pretty specific, down to the point where you're breaking it up into every single step that has responsibility to one or more individuals, right? The more complicated the task is, the more granular it needs to be broken out to. Number 2, which area is it? This is really just for organizational purposes. Is it AR? Is it cash? Is it, payroll? I like to put in whether or not the task is routine or ad hoc, right? Is it monthly, quarterly, annual? Is it just this one time? Why is that important? Well, beyond knowing when something should be done, monthly, quarterly, annual, it also helps to know how many unscheduled activities we have every month, because this is going to speak to the maturity of your close process. If your close checklist has 10 items, but there's 25 unscheduled activities every month, that's going to tell us that we probably need a better closing checklist, right? Risk level, is it critical? Is it low risk? Is it medium risk? And this is helpful in the case where, we do live in the real world. Sometimes we can't get to everything on our closing checklist, right? Sometimes we can't get to everything right away. And knowing the criticality of the tasks is going to help us prioritize in the event that we have to choose a subset of activities we are going to complete timely on our closing checklist. Ownership. Again, we don't want orphans. Who is doing what? Does it require a review? And if so, who is going to do the review, right? We want to be really specific and have accountability. If applicable, instructions. How is this task supposed to be done? And that could be accompanied with other documents as well, but some documentation as to at least where things are, right? Go to this drive and get that, and then compute this, and then do that, something like that. Deadlines, when is it due, right? For me, it's not that helpful to say day +2, right? Because that could be March 2nd or, May 5th. So that's something where we should just really spell out, it's actually due February 15th at, if you want, 10 a.m. The status, whether it's done or not. If you have an automated checklist, you can have more granularity on the statuses, but at least have a place that says, is the thing done or not? When is it done? Who did it? Any special comments? Are there source documents? This is really, really important. When you complete a closing activities, not always, but a lot of times it results in documentation. Where are the documentation, right? It can be a URL. It can be, in this binder somewhere. We need to reference that. And then results, whether the task was done ahead of schedule, on time or late, and that's going to help us when we actually do our process improvement to see, what is late and does it make sense and should we adjust? So it ends up looking something like this. I mean, you could do this offline in Excel for sure, and many companies do, but this one here is a screenshot that is taken from our task module. But you can get pretty close using a spreadsheet. It just won't be automated. So you actually see that the category of tasks is displayed and the specific task is underneath. You can see that a lot of these activities are already late, but the due date is displayed. The person assigned to is displayed. You can, there's a review workflow. When something gets signed off, you actually have the opportunity to attach documents electronically, which a lot of our customers really love. And then you also have some custom fields where you can designate things like, like a special reference, like a journal entry number or something like that. So where automation in this area would really help is in the creation, the maintenance, the tracking, and the document repository aspect, right? Because once you know what to put on this checklist, you can schedule it with our system where every month you have a fresh checklist, where due dates are pre-calculated, where you can sign off digitally and electronically attach documents, run reports, generate email alerts. It removes a lot of the sort of pure admin aspect in my mind of the close, which is why I recommend automation in this area, even for teams that are closing really well, right? It's going to get you to a much more streamlined and polished state if you have some help from a technology standpoint. Okay, so I want to talk about the closing calendar versus the closing checklist. I know a lot of folks keep a closing calendar instead of a checklist. A financial close calendar is different than a closing checklist. Both are good. Both are better than not having anything and kind of relying on your memory to do the close. Even if you are using a closing calendar, if your close is at least of moderate complexity and it involves more than 2 people, I would say it is recommended to also have a closing checklist that houses all the information we just went through, right? Why is that? What is the difference between the two? And this is especially important if you are looking to do some work around your close process. So a closing calendar is nice because it's very visual and it's displayed in calendar format. The problem, though, is that it usually lacks sufficient detail. Closing calendars are generally more high level. So in the example that I mentioned before, quote, complete fixed assets. That is something that shows up on your closing calendar. But the fact is it's actually composed of, several tasks. You have to identify acquisitions and disposals. You have to reconcile. You have to depreciate. You have to book journals. You have to X, Y, Z. And it's important to break those activities out because first of all, these are the steps you don't want to forget. Second, they may not be done by the same people. And sometimes even those subtasks need to be broken down if you're dealing with different entities or different countries. And it's much easier to get to that level of detail with the checklist as opposed to on a closing calendar. Number two, the calendar can sometimes cause some confusion when it comes to ownership, right? If it's just one or two people working on a close, then it's not that hard to figure out who's doing what. But if you have multiple people, maybe across different offices, coordinating the work, then it does become harder to see who's supposed to be doing what. And the ownership of these activities are not always clearly outlined when you're following a calendar. Number three, status. A calendar does a good job of showing when things are due, but it doesn't do such a good job showing you whether they are started, whether they are in progress, whether the work has been rejected and needs to be redone, or whether the thing is done. And you really need that information if you're going to do any sort of analytical and tracking and monitoring during the close. Number four is results. It's much harder to track whether a task was completed ahead of time, behind schedule, right on time, right? Because the calendar gets moved around usually to match with what is actually happening. So at the end of the day, you might know when things ended up getting done, which is great. We need that. But we don't necessarily know, well, I did this thing day plus A, but really it should have been done day minus 2, right? Something like that would be good to have if you're going to be doing some process improvement work. Number 5, when it comes to guidance on leading practices on doing a strong close is you really have to pay attention to your reconciliations. Reconciliations are a big ticket item during the close. And I'm talking beyond your cash recs. I'm talking about the entire balance sheet. You have to reconcile it, preferably monthly, but at least quarterly. So oftentimes accounting teams, especially leaner teams, so this audience here, they really struggle with 2 issues. Either they're not doing recs properly, or the recs are taking too long, so they don't do them, or they take too long to do them, or both. So what do I mean when I say reconciliations are not done properly? This is one example. If your current sort of reconciliation work, and I'm using quotations here, consists of listing out the prior period balance at the top, and then stating all the transactions in the period, and then you add it up into the ending balance on a spreadsheet, and then it's supported by the transactional detail of the account from your GL, like you see up here. This is typically not a correct reconciliation, because what's happening here is simply you're listing out all the transactions and then tying it to all the transactions, which you're going to tie. That's the good news. So let's take a look at what it takes to do a better reconciliation. I'll give you an example. A true reconciliation usually starts with the ending balance of the current period, okay? Not the beginning balance. It's going to start with the ending balance, and the reconciler, their task is to validate and support that entire ending balance. So in this example here, the ending balance is $1,100. Next, you're going to come up with supporting detail, right? Things that explain the makeup of the balance to see if anything is misbooked relating to the account. Whatever it is we put in here to support the balance, we should have supporting documents, right? Source documents to back it up, right? Why do we say it's $500 on this deposit? Well, here's a contract, right? There we go. Vendor documents, internal ledgers, analyses that's performed, something that proves the support. To the extent that our supporting detail doesn't fully validate the balance, like we can't support all of the balance, we would need to identify potential timing differences and adjustments. And timing differences, adjustments, they're items that we've identified to bridge the gap between the GL and the sum of all your support. So for example, we could identify some sort of timing difference that consists of a deposit that is supposed to be returned the next period, right? That's why I have highlighted here. Adjustments and timing differences are temporary in nature, meaning that they're okay to show up in the reconciliation, but for a limited time only, like a clearance sale. And what is that time limit? Well, it's usually 30 to 90 days. So if there's a temporary item, we monitor it and try to resolve it within 30 to 90 days. After that, unless there's a really amazing reason for why a temporary item should stay on the books, we usually will adjust the GL and write it off. Okay. So in this case here, I have a timing difference, some XYZ deposit return that is supposed to be happening, age 61 days. So I'm going to look at it for another 30 days and probably, where's my return, right? If not, I probably need to do something about it. And then lastly, whatever is left over is your variance. This is the amount, there's a variance of $30 here, and this is the amount that we cannot substantiate. To the extent that number is material, we can try to investigate it next period and or, write it off. And then of course, the rec needs to have some policies and procedures documented, meaning what is the nature of this account? How does the company use it? How should the reconciliation be done? What are some red flags that we should not be seeing, right? How to do this reconciliation? Where is source information going to come from? So instructions that kind of gives you some information about what this account is and how it should behave, and also how to do this reconciliation. So you can see here that this is a completed one of a very basic reconciliation, but it looks very different than just listing out all the balances and then, slapping it on top of the GL transactional detail. It is not only a lot more in-depth and analytical, but it also requires monitoring prior period items. And if you do this work right, if you follow the leading practices when it comes to reconciliation, it can sometimes take a lot of time. And to make things worse, these reconciliations have a very short window, as we know, in terms of their effectiveness, right? To maximize their effectiveness, you really should reconcile all your balance sheet accounts no later than 30 days after your period end. Once the work is delayed beyond that, the power of the reconciliation work starts to decrease dramatically. So doing the same amount of work on these reconciliations 15 days after end of the period versus 90 days after the end of the period, right? The consequences are huge. The effectiveness differences are huge, even though you apply the same level of work. So this is where automation can really help. Number one, it is going to cut down the volume of recs, right? If you have 8, 10 properties, every property has a balance sheet, you're closing them separately, reconciling them separately. This would be a great area where automation can come down and within the first period, cut down 10 to 40% of your reconciliation volume. So instead of doing 30 recs per property times 10, right, you are now doing 10 to 40% fewer right away. And the reason is because you're going to be asking the system to look for patterns and apply algorithms to take a first cut at these reconciliations. Where automation can really help, especially if you have more than 3, 4, 5 people doing this work, is to ensure quality. And we do this through our standard forms. Having a standard reconciliation form is a really good idea so that number one, you don't have to keep all your recs in Excel. And number two, if you have a multi-entity situation where different people reconcile the same type of accounts, this is a great way, having a standard form, to ensure that we're all kind of following the same steps and our work product looks pretty similar when it comes to reconciling the same type of accounts, so that you don't have Nancy here doing her thing and then Bob, over there in the Eastern office doing his thing, and our recs just look completely different and we're doing totally different things on these reconciliations. Number 6, do not forget to do your flux. It is not uncommon to think that, hey, if I'm following a closing checklist, I'm booking my journals, I'm doing my recs, and my numbers are gonna be pretty good. And they're all great things that your team should be doing as part of the close. But leading practice also recommends that we perform a flux analysis on our balance sheet every month. And for those of you who are not familiar with what a flux is, it is simply the act of comparing this month's trial balance to either last month's trial balance, last quarter, or last year, or some sort of prior period balance. And the point of this is really to see if there are any patterns that are just out of whack that your team should be investigating and looking into. It's a very different way of reviewing your numbers. And a lot of CPAs find this challenging because as accountants, we're kind of trained to like be really precise, go down to the penny. And this is a sort of like a macro level way of reviewing the balance sheet to say, oh, well, if our AR went up 50% month over month, is this a problem, right? Or if payroll expenses went down $20,000 this month, is this weird? And if it is, we kind of look into it. See, does it make sense? Like generally, is this the right trend that it should be happening? Or maybe there's a mistake somewhere, or maybe there's something, really fishy that's going on that we should take more of a focus on. So it's just another way to inspect the financials every month for, again, opportunities to catch mistakes, errors, fraud. And if you're audited, your audit team will probably ask you to do this, flux or roll every quarter. But we recommend that teams run their own flux every single month. Now, is it more work? Yeah. So where automation can really help with this exercise is you're able to set up the flux to run on its own and say, while I'm closing and while I'm reconciling, our system can also be running your flux analysis at the same time and say, look, while you're doing all that work closing, you have 50 accounts on a balance sheet. 10 of them has a weird flux going on, right? The thresholds have been exceeded. There's a big movement. Come take a look at the 10. See if you care about it or not. See if you want to apply some extra rigor when it comes to reviewing and really digging down into those distinct accounts. But the rest of the 40, they look fine. No worries. You don't have to look at them. So that's the idea of a flux. Along those lines, I also want to talk about employing thresholds. All successful projects, and I guess I might add successful relationships, thrive on setting and respecting clear boundaries and limits. And the close process is no different. We need to clearly understand where acceptable thresholds are for every type of activity, again, so we can distinguish between what deserves our attention and what doesn't. So if you work in a team right now where you have super coverage over everything, your close is really thorough, it's always on time, you're in love with it, then you don't need to do this. But if you're feeling like, I wish I can get you more, or I'm not sure if I spent enough time on this, or maybe too much time on that thing, this is where we can start to think about thresholds. Mostly around, maybe materiality. Do I have a slide? Great. Materiality, right? Does it make sense that I'm looking at accounts that are like $5 and spending an hour on it? Maybe not. Does it make sense that I am looking at every single journal posting, even the ones that basically have no P&L impact? Well, maybe not. And this is about thinking through these type of situations and figuring out when am I going to care about something, especially if you're a manager level person or executive and you're finding yourself reviewing every single journal. This might be a situation where you kind of sit down with your team, maybe with your management, maybe even with your auditors to say, hey, let's set up some thresholds so that I am not just diving into every single thing and really spending my time in a way that's not allocated best given our risk profile. So a note on thresholds, if you do want to set them, do make sure that you have thoroughly researched and documented some of these thresholds. So obviously you got to talk to management. Obviously you got to be getting some clearance with your audit team. But what I'm talking about here is, hey, I'm actually pulled up the last 5 years of all of our, account balances and have decided that because of the way this account is behaving, I've decided that anything below X dollars, I am not going to work on, pay attention to, try to resolve, because in the grand scheme of things, it is immaterial, but I have all these numbers, all the documentation, all the analysis to support that. Once you set up these thresholds, you have to follow it. And you don't want to be like willy-nilly in terms of, oh, well, today I'm going to follow these thresholds, but next month, I'm just not. So do try to be consistent. And then lastly, just making sure that these decisions have been agreed upon by a team so that there's no nasty surprises later on when someone is saying, why didn't you review all of these $5,000 entry? And you say, well, I've decided that they're not important, but your management disagrees. All right, we don't want to be in that situation. All right, let's go ahead and run our third poll. Oops. Have you considered adopting a month-end close and reconciliation solution? Let's see if this is something you've thought about in the past or are interested. And then after this poll, we're finally going to get to the glamorous part of improving the close process. 45 minutes in, we're finally going to do it. I'm going to give it about another 10 seconds. All right, I think we're pretty good. Very cool. So now we set goals and milestones. And for many people, this is kind of first step they jump to when they talk about improving the close process is, oh, let's get the days to close down. Let's, that is not only not our first step, but it's almost like our last step. 10-day close, 5-day close, 1-day close. These milestones are really important, and they're often the catalyst for someone, taking on a project to say, look, I don't want to close in 10 days anymore. It's just too much time wasted, right? However, it is really never the first step when it comes to actually working on the close, because these benchmarks are way too high level. Telling you want to have a 10-day close to 5, it doesn't really tell you what it is you need to work on. So what do I have here? Oh, okay. So what I have here is actually another set of milestones that you can consider following. There's a lot. And if you do a Google search, it's going to give you a ton more metrics when it comes to the close. But the key takeaway here is that I just want to let you know there are some options. They're not just 1 or 2 metrics available to measure the success of your close process. There are a lot of metrics that you can use and discard and take on within your close improvement journey, right? You're not married to these metrics. So, and there are also benchmarking companies out there that, your industry might be a part of that can give you some rough guidance as to what you should be expecting for every metric. My recommendation here is in terms of measuring, especially if you don't have automation when it comes to close, start simple. Don't pick too many, because when you have too many metrics and people get overly excited, what's going to end up happening is you spend all this time pulling data and it takes away from your close work. And then everyone gets so tired that they just abandon and give up on the project. So where automation can really help you in this case is in data gathering, right? Be able to say, okay, well, once you decide that these are your thresholds and milestones and goals, because you're working in the system gives you dashboards and reports and tells you how close you are to meeting your goal or not. And that could be a really helpful guide in your process improvement journey. But you could do this without automation as well. It's just a little bit more work. So once you set your goals and once you see how you're doing compared to your goals, there's going to be a gap, right? It's not going to be like hitting the goal right away. So then we analyze and tweak, right? Taking a look at how far apart we are, and then what could be the root causes of these issues. Some of these fixes really depend on the cost. So if AP should be closed on day 1, but somehow stays open until day 3, there are many reasons that could be the case. And we want to really be able to figure out what is my company's reason or reasons for these delays. And then you can apply a remedy to it. And this is where you're going to need some brain power. You're going to probably need all your team together and figure out, hey, guys, this is what we're trying to get to, and we're not getting there. Why? And what it is can we do to remedy that? And the answer is going to usually be in one or a combination of 3 things. It's either people, process, or technology in terms of the the root cause and in terms of the remedy. So you're going to find your answers in one of these categories or a combination of the 3 categories. It's either a talent and resource availability issue, it's either a process problem, or it's a technology problem. Finally, all these great learnings that you're going to be, gathering, you want to be documenting that and then adjusting your close checklist accordingly. And you also want to make sure that you are properly cross-training. So when it comes to cross-training, for smaller departments, it's probably already old news because you probably already back up each other all the time anyway, just because you have to. If you are in a mid-size or a larger department, it may not be such a regular thing, but cross-training really needs to happen, and it needs to happen more than once. It's not enough that, you learn the thing once and then call it a day, because you're going to forget. It's also not enough to just rely on your policies and procedures and assume that if I read all this stuff, I'm going to know how to do the work, because we know that almost never happens, even in the best environment where things are documented very granularly. It just doesn't happen. You have to do it. So rotating up your backup, it doesn't have to happen every month or even every quarter, but just every so often, we should all be brushing up on tasks that we're backups for, or assign backups to certain things to keep things familiar during the close. And one of the best ways to do that is for everyone to make sure that they are taking their vacation, right? Because if you are taking your vacation, you are mandatorily not at your desk, which means that someone has to step in to help you with that work. So taking your vacation is not only great for cross-training, it's also, I don't know if you know this, it's a key anti-fraud control. That's actually an internal controls to prevent and detect fraud, is by making sure that everyone has an opportunity to take an extended vacation, right? Being away for more than like a day, right? And where someone else has to step in and take over their work. Oh, here's my slide for that. Okay. Let's go ahead and run our last poll. This is our fourth and final poll. Which of the below is generally not a main component of a properly prepared reconciliation? Is it the GL balance? Is it all the transactional detail for the reconciling period? Is it the supporting detail? Or is it the timing differences and adjustments? We'll get about 20 seconds. And for you folks out there, if when I was talking about these reconciliations, if you were thinking like, oh, what the heck is this all about? Or it sounds very foreign to you or unfamiliar, I would encourage you to sign up for our March webinar, where I'm dedicating a whole hour just talking about how to do reconciliations, how to review them, how to pass audit, that sort of thing, and the concepts behind why, for example, why do we reconcile cash differently than a subledger, right? Why is it that we're requesting a bank statement when we reconcile cash, but we're not requiring some sort of statement when we do our subledger reconcilitions? Or why is it that we reconcile our allowance for reserves with a spreadsheet? So we talk about the importance and the foundational sort of philosophy on how we do reconciliation, so that you can decide what type of reconciliation is best for your given account, so that you're not just following, whatever the last person was doing before they left the company. All right, I'm going to shut this down. And the answer is B, or 2, or the second one, all transactions for the reconciling period. That is typically not a component of a reconciliation, but there are some exceptions. All right, so that does conclude our topic for the day. If you do want to reach us after the session, feel free to check out our website. That's probably the best place to go, skystem.com. Lots of resources. You can book a demo there, download ebooks. We got videos, testimonials, and then you can, take a look at how other people are taking that journey to month-end close automation. I'm going to go ahead and turn it over to you, Brittany and Miriam, if you want to conclude.
Awesome. Well, thank you again, Nancy, for taking the time today. Does anyone have any last minute questions? We only have a few minutes left, but if you want to go ahead and drop your question kind of while I'm wrapping this up, feel free to do so. But as Nancy mentioned, SkyStem offers several webinars each month. Be sure to visit HFTP's website. We have a webinar kicking off next Thursday, Staying Power, How to Keep Employees Longer. And then we already have our March schedule kind of up, and all of the webinars are available for registration, and they will have CPE credits for them as well. So keep that in mind. And as you collect, if you are collecting continuing education credit today, please note that you will need to self-report your credit for this webinar through the certification tracking spreadsheet. This spreadsheet is available at the bottom of the HFTP webinars webpage. In addition, an email with the CPE credit certification information will be sent within 24 hours. So please save that email for your record. And with that, that concludes today's webinar. Thank y'all all for attending, and thank you, Nancy and SkyStem, for sponsoring and having this opportunity for us.
You're so welcome. Thanks, everyone. Take care.